So welcome everyone and good morning. We have a very exciting session today, and I know it's very rare to get in touch with those who work in the backgrounds at Trade Shield. There are a whole bunch of teams, even though I know you're used to seeing myself, Martin and Neil, but we do actually have a lot of other people who work at Trade Shield. And one of those amazing brains that we have with us today is Sahil, who is our head data scientist. And what we're going to be talking about today, is expected credit losses, and which is part of the IFRS 9 process. And we're going to just be talking about what is expected credit losses, how do we calculate it, when do we calculate it, what's the method behind it, so that we all understand what it is that we're talking about. So thank you so much, Sahil, for joining us today and for taking us through this process with you, and exactly what Neil said. So I'm here to be able to speak English while you speak maths. I saw in your presentation earlier that there was a par sign, I think it was. I don't know what it was, but I was like, I don't know what that is. And I'm sure we'll see it shortly. So very excited to learn from you. And of course, to everyone on the call, this is a wonderful opportunity. If you've got any questions, please, by all means, raise your hand and we can definitely reach out to Sahil for comments. So I'm going to let you start off, Sahil, and we're here to support you. So very exciting.
Thanks, Amy. Yeah, I'm just going to share quickly. Please let me know if you can see the screen.
Yes, we can. We can see it, just not in presentation mode yet. Oh, there we go.
Amy already introduced me. So part of the Trade Shield team, heading up the data science division and IFRS products from Trade Shield side. We do have a few clients currently using the solution, and we're automating it currently as well to give monthly results. And yeah, so I'm just going to kind of take you through the background. What is this IFRS 9 calc? When do we use it? I'm not going to get too technical because an hour is definitely not enough to go through the intricate details of it, but you can stop the session at any time just to ask any questions you may have. Okay, so there's no questions. I'm going to start.
Let me just say one thing for you. What we're just talking about today is ECL, or expected credit losses, which is one of multiple different steps in the IFRS process. So that is just to bring it in. We have spoken about IFRS before and the multiple different other sections that are involved in that. So I just want to just clarify that we're just speaking specifically about expected credit losses in this particular forum. And if there are questions with regards to other areas, we can definitely try to see if we can answer you, or else we will be able to direct you to somebody else within the business. But just to give it a breakdown of which area within the IFRS model are we focusing on today.
Now, I think it's also just important to give some clarity as to where expected credit losses came from and what it is. Originally, credit people used to do bad debt provision. And that was when they selected accounts that looked like they were going bad and made specific provision for it, so that should they go bad, they can write it off against the provision. The clever people in the financial industry then decided that they need to make provision on every single invoice that is raised, but in a different format and to a different value. And then that is where this calculation originated from. And that is what we are going to demonstrate in this piece.
Yeah, thanks for that, Martin. Yeah, it's a very interesting history behind IFRS 9. I think if you ever get a chance to watch the movie The Big Short, it's one of my favorite movies. Please do watch it. Yeah. Someone needs to mute. Yeah, cool. So the origination of it was mainly used in banks. It was due to the 2008 financial crisis. It was one of the worst times in finance, and the reason why it got so bad, there wasn't any regulation in place to calculate expected losses. So basically, what the big banks were doing at the time, they weren't writing off any bad debts. They used to make their books look squeaky clean without realizing that majority of their mortgage loans were actually in default, and Yeah, so it caused like a very big issue. I think the financial crisis was way worse than even COVID. People don't realize like it was uh catastrophic. It was end of the financial industry as we know it. Yeah, so if you get a chance, The Big Short's amazing movie. If you do watch it, I believe it is on Netflix. So yeah. So I'm just gonna start with some intro and concepts that you should be aware of before we get started. So what is an impairment or provision? Basically ECL. So it's money kept aside to cover the amount of money that a financial institution expects to lose on a credit product. So you could be giving out any type of credit, and it's basically, let's say you have a debtor's book of 100 million rand, right? Do you expect all of your debtors to pay? That never actually happens. You always have debtors that go bad that you need to account for. So in your financial statements, you can't recognize the entire proportion as your income because a lot of them are going to go bad or default. So you need to adjust for that. So that's what's a provision or ECL. Credit products. So you're very familiar with loans, which is mostly your mortgages, your vehicle finance, banking products, and personal loans. But credit cards, overdraft, clothing accounts, that can also be a credit product. And then there's some non-credit products as well, which is your trade receivables, basically your debtors book. So the ECL or expected credit loss formula is broken up into three parameters. You have your PD, which is what is your probability of defaulting. Default has a very specific meaning in the industry. It's usually 90 days overdue. So what's the probability of a debtor moving into 90 days past due? Then we have something called the EAD, which is your exposure at default. So when you do default, when you reach the 90 days, what is your exposure? How much do you owe at that time? A good example will be to think of a credit card, right? So let's say I'm given 100,000 Rand limit on my credit card. At default, at the moment, if I'm only spending 10,000, right, I have a specific probability of defaulting. When I do reach the default stage, my revolving credit is 100,000. How much of that 100,000 would I have used? Would I be at 90,000? Would I be at the exact 100,000? So that's what EAD tries to model. When I do default, how much of the credit would I have used? If you think about it as a home loan, it's basically how much do I have left on my home loan at this point in time. And then LGD is your loss given default. It's given that I have defaulted, how much of, given that a debtor has defaulted, how much of that money can I actually pull back? So it's a higher amount it's actually a lower amount for your houses. So if you think of different kind of loan products, so you have your home loans, your vehicle loans, and your trade receivables. So when it comes to like your home loans and vehicle loans, it's something called a secured loan because there's a security behind it. So if you don't do your home payments, we can basically pull back and take your house or your vehicle. Whereas if you think of a credit card, that's more unsecured loans. That's like personal loans. If you do default on that, there's no real security behind it. You're going to default. We have nothing, basically nothing to recover from you. So usually what happens is for your home and vehicle loans, we take a haircut. So meaning, let's say your house was 1 million Rand. We know that if you do default, we can only recover 650,000 of the 1 million Rand. So that's how the LGD piece is actually calculated. For trade receivables or your debtors book, this is very dependent on whether your specific debtor is insured or not. So if they are insured, maybe your basically for your credit insurance, you recover 80%. So it's all decided, by your insurer, and we actually take that into account with the LGD parameter. Step two is
Sahil, on that,
yes.
just to like maybe bring it into our customers' environment, that LGD could also be if you trade within like a consumable type environment versus if you trade in a services environment. Because you can't take back your services. So, for example, if I was charging for this training session, I can't take it back. What's done is done. But if I trade within like the tires industry, for example, then I would be able to recover the stock potentially. And is that what you're referring to if I were to bring it into our customers' environments?
Yes, definitely.
Okay.
Yeah, and a lot of our customers as well, for the bigger books, they do insure them sometimes as well. So but they don't, no company will insure like 100%. So they'll probably only
Yeah.
insure, some of them get insured at 20%. So you make a 80% loss. Your haircut is, or your loss is much higher, depending on what you have. Yeah, and as I said, if it's secured, if you can recover some of those goods, or you have, maybe
Personal surety.
Personal
collateral. It'll all depend
safety,
on that. What you can, what your LGD would be. Thanks for
Perfect.
the question.
and things like that, that is what we call tangible security. So anything that's a tangible security that can reduce the LGD is going to then be taken into consideration calculating the expected credit loss.
Yeah, exactly. Thanks, Martin. So the next step, what we do is we actually present value the PDs, and because they're basically cash flows and they should be present valued. Usually it's around inflation, or if you actually financed, so you took financing to actually get the product to the customer, to actually generate stock, to actually give it to them on consignment, then yeah, we take that into account. But usually when it comes to trade credit, because it's such short time intervals, they trade at 30, 60, or 90 days, it's a negligible value. So we don't currently take this into account. But if you were trading maybe in a year, like think about a cell phone, right? So a cell phone contract runs for 2 or 3 years, then we would have to present value it. You can't recognize the entire loss or even the asset itself at this point in time. You sold it, but on terms, on very high credit terms, if that makes sense. And we always have to consider present valuing those cash flows.
So some of our clients are exposed to longer terms than that, because we have some of the agricultural clients. And of course, they've got two accounts. They've got the normal monthly account, the 30-day account, and they've got what they call an annual account, where they buy something on an annual basis, like seed, for instance, and they only pay for it in 365 days.
Yeah, so
So
that they would have to, in that case, they would have to take into account the present valuing of that cash flow. As I said, so there is debate around what to present value it by. So people take like current interest rates, some people take inflation, and some calculations are actually done in terms of how much the ROI is, or their return on investment, how much they want back, basically. Yeah, so that present valuing interest rate is very kind of negotiable, dependent on what the company actually wants. Yeah, but that's a good example of when you would need to present value, especially those longer terms, because you don't want to fall into a cash flow issue over time. So, is there any questions? Can I move on?
I see no questions, Sales. You can carry on.
Okay, yeah. So risk drivers. So what are the risk drivers when it comes to ECL? So this is kind of referring specifically to wholesale models. It was just because of the audience, and I think most people use this kind of concept. So it's your small and medium-sized entities. It could be large corporates, and they specialize. It's specialized lending, trade, basically trade credit side of things. So what we look at is behavioral indicators. So your current arrears, your arrears history, behavioral score, the utilization, and days past due is what we take into account. And then we also take into account qualitative factors like your manager's character and expertise, by looking at how long they've been with the company, judgmental outlooks. Does this company have any judgments against it? Quality of governance is like around how many directors you have, and the industry itself. What industry do you operate in? So these are just some of the risk drivers we do take into account. Obviously, it can be much more depending on the client and the industry they involved in, and the data they have. The more data you have, the better it is to calculate these risk drivers. Okay, I'm gonna move into if there are no questions around this.
There's no questions, Sales. You can carry
Okay.
on.
Okay, so trade field methodology, this is specifically for Trade Shield and our clients, is we follow the rollover matrix approach with adjustments for economic factors. So first is the collection of payment profile data, how your debtors are actually paying over time. Then we have our internal risk classification model, which is our default risk model, and it takes into account how they're paying with other clients and you, and it basically we do some risk classification. So we usually it's done from very low risk to very high risk, and then we calculate average rollover rates per risk class, like given you in class one. Okay, Neil, I see you have a question.
Just a quick one, Sahil. Are all of these 6 steps referring to the ECL specifically, or is this IFRS 9 as a whole?
It's basically how not okay. So it's how we calculate the ECL amount.
Okay.
Yeah, as a whole. This is as a whole,
Perfect.
not any one of the parameters. This is the entire ECL.
Okay.
Yeah,
Thank
cool.
you.
So after we classify you into one of our 6 risk classes, we calculate the average rollover rates, basically looking at if I'm currently within terms and I'm risk class one, what's the probability I'm going to move into a default state 90 days past due? Even though I'm within terms now, I still need an estimate of me moving into a default state. Then we adjust the rollover rates for economic factors, and we have shown that economic factors has a very, very big impact on how debtors pay. Think about it this way, like if you increase interest rates or CPI, or your employment rate goes down, your customers are not really going to pay you on time, or if they have to take a loan out to pay you, they're going to pay very high interest rates. So sometimes it basically affects their behavioral stance on how they're going to move throughout the buckets. Then we determine the loss given default. So as I said, for now we take into account a lot of insured books. So a lot of customers are insured, and we take that in the LGD parameter. And then we finally determine the expected losses adjusted for the economic factors by Monte Carlo simulations. So Monte Carlo simulations, basically, it's a statistical method that helps you, if you know what your risk drivers are and where your uncertainty comes from, you can actually model it in such a way and pull in that uncertainty and account for it when you are doing your ECL calc. Um, yeah, there's a lot of books on it. It's very fascinating. It was used during the wars as well. They actually deployed the solution quite a bit into how many tanks should we send to A, B, and C. And yeah, it's a very fascinating kind of statistical approach to take to for decision making. Okay, so the PD parameters. Yeah.
I have one question on your previous slide. So obviously, this is the way that we at TradeShield calculate, ECL. What happens for customers who don't use TradeShield in this particular instance? Obviously, they're not going to have the payment profile information. They're not going to have default scores. How would they do this manually? Obviously, would it just be not as comprehensive? Like, what would they do?
Yeah, so I have seen some clients use like non-statistical approaches as well. So it also depends on industry knowledge. I think there was a client that well, they kind of use us as the competitor model. Obviously, they're more in the industry, so they know what to segment by. When they do calculate these rollover rates, they do use a similar method, but as I said, they don't really take into account the economic adjustments, and they also, yeah, it's basically your industry knowledge when you calculate the rollover. So what do I segment by? I know it's hard to come up with examples now, but I know in my industry, let's say I sell, okay, I'm actually giving out, as I said, I'm giving out home loans or vehicle loans, right? So with my specific type of loan I'm looking at is, I know I need to segment between, homes that are over 10 million and then loans that are below 10 million. That I believe is a logical segment when I am calculating rollover rate. So it's all like, it's almost like industry expertise that within your client. So you need to know your clients very well, how to segment your book in such a way where it makes sense and you can see differences in the population. Obviously, if you're segmenting your population, you need to show and be able to justify that these segments make sense. And if you're not taking economic factors into account, you can maybe back it up with reasoning. Maybe your clients are not affected by economic factors. Maybe for reasons these are all kind of insured books, or yeah, there can be a few reasons, but yeah, it's definitely possible to do it on your own if you do have if you know your clients extremely well.
And of course, also taking into consideration previous write-offs as well.
Yes.
Which
So
which is leveraging off your own data, I suppose. So we leverage off everyone's data, but you could leverage off your own data as well.
yes, so there is a drawback to that because you don't recognize something called seeker. So seeker is your significant increase in credit risk. So it means that so I know how my data is trading with me, but how are they trading with others? So it's a precursor, like a customer could be trading very well with you. They're within terms, they're not in an overdue state. But then with another client, they could be trading over terms, which is something you should take into account. But I'll maybe explain this late in the later slide. I do have the seeker adjustment there. Okay,
Perfect.
this is speaking to the PD parameter. So it's your probability of default parameter. So the PD parameter usually goes through a couple of steps. So this is your probability of default. So there's model development, model calibration. So that's calibrating the model to your specific historic data. Then it needs to go into independent validation. So yeah, at Trade Shield, we do have external consultants actually look at our model, and obviously there's model implementation and model monitoring. So the model monitoring is where you look at your AUC, or your accuracy of your model, see how well it performs. Over time, a model does decay. So what would happen is your model becomes, you haven't retrained it, the parameters are not adjusted. So you need to go through this constant phase of model monitoring to see when your accuracy goes below a certain threshold, which is an industry standard, or I think it's around, for AUC, it's around 70 to 65% to 70. You need to retrain your model. So it's the PD parameter is kind of goes through this constant cycle over time because a model does decay. So whenever you build a model, you should know that it will eventually decay over time and you will need to retrain it. So that's usually what happens with their PD parameter. Then the next one speaks about a concept called the Markov chain. It's just a nice way to demonstrate what can happen to a specific loan or credits or a debtor over time. So we usually the one segment that's a must if you're doing an IFRS 9 calc is your stage 1, 2, and 3. However you define it, I'm just going through industry standard at the moment, but we have a lot of clients that have multiple stages. They can even go up to stage 5. They have a stage 6. So it's not set in stone. Maybe in the banking industry it is set in stone because that's kind of the foundation of where the regulation started. So they're very strict and have to stick to this definition. But as I said, for trade credits, we can have higher stages. So what you get is your stage 1, which refers to your performing loans or debtors. So they are in arrears 0, which is not in arrears, up to 30, not including 30 days, right? So they are a bit overdue, but not up to 30 days, and they are not in seeker. Seeker that I mentioned earlier, don't have a significant increase in credit risk, meaning from what we can see with the data we have, the way they're interacting with other clients of ours, they're not overdue on anyone else's book. They're not overdue on our book. So we refer to stage 1 as performing loans or performing invoices, however you define it. So that's your performing. That's basically what you want your book to have. You always try and get the majority of your book in a performing stage. If you have a lot of debtors that are performing, it means your book is in a healthy state. Then we have stage 2. So stage 2 includes arrears. So they're in arrears 0 to 30 days, but they also in seeker state. So this is a situation where they're performing in your book. So they're within terms or slightly over in your book, But we look at, so a good example of this would be in the banking sector, right? So they have multiple accounts with you. Let's say they have a credit card, a home loan, and their everyday savings. So what banks actually do is they see that even though you are performing on your home loan, right? You're paying it on time. We identify that you are very, very late with your credit card. So what they do, they automatically adjust you and push you into a stage 2 state because they say you're a more riskier client at the moment. And you move into a stage 2 because we need to treat you a bit differently because we see you at high risk of defaulting. So you move into the stage 2 phase. And then the normal definition looking at your arrears is 30 days, including 30 days, all the way up, excluding 90 days. So you in or an overdue state between 30 and up to 89 days, not including 90. And the reason not 90 is that stage 3. That's basically the most commonly used default definition. If you are 90 days plus due, you are in default. And that's basically once you're in default, your probability of your PD is actually a 1 because you are in that state already. Your PD is 100%. What can you do if you're in stage 3? In stage 3, you can cure. So you can move back to a stage 2 state, and that's where the cure step speaks. It's on the left-hand side of default. If you are, so it's like a kind of your book constantly moves. And then what can happen once you in default, you can either cure, move back into a stage 2 by paying on time, because you would still be identified as seeker because you have historically been in default, or you can go into a write-off stage that we know we will not recover anything from you. Your business has closed, or there's no way. It's called in the Markov chain, it's called an absorbing state. So you can see, or exit. You can see that once you are in write-off, there's no way you can move. You in a very solid state. It's like there's no movement in or out of the state. Yeah. Yeah, and the same goes for performing. You can move from performing to seeker. You can move from to stage 2. You can move from stage 2 to stage 1. So it's all dependent. It evolves over time, and we model every single possible scenario that can happen. So if you're in a default state, there is a probability you can be cured again, and there's probabilities attached to this, and that's what's a Markov chain. It's basically all possible scenarios that can happen with a loan or an invoice. And we try and model every step because if you are a customer, think of it in terms of you. If you have a loan, you can be in a performing state, and then the next month you can move into stage 2, then eventually stage 3. Or if you are currently in stage 3, you can actually cure all the way back to stage 1 if you just pay off all your loans and move back into a performing stage. So stage 1 is usually referred to as performing, and then stage 2 is non-performing, and stage 3 we commonly refer to it as default because that's our default definition. It is quite a lot to take in now. Is there any questions on basically stages of loan?
Just one clarification so that people understand what you're saying. The 30 and 60 day that you're talking about is after terms. In other words, whatever the term is, I have given my data, that 30 days up to the 89 days for stage 2 and 90 days is 90 days after my terms. So if my terms are 60 days, it will be 90 days after 60 days. If my terms are 7 days, then it will be calculated at 90 days after 7 days. So it's always that period plus the term that you have given the client. All right. And then once again, you must remember if you give a client 30 days from date of invoice, then it's 30 days from date of invoice, then this term starts. If it's 30 days from date of statement, then this starts from 30 days of statement. So you have to understand what the term is that you granted the client to understand when does these different stages kick in your calculation.
Yeah, exactly. Thanks, Martin. So it's all based on the terms you are given. So yeah, they all based on terms. So they're all in overdue. The only reason for the performing stage we have it at 0 to 30 is because especially in the banking sense. Some customers, you get the option of I can pay on the 1st, I can pay on the 5th of the month, and it just performing in terms of definition, it just helps if you have it from 0 to 29 days, not including the 30th day. It just adjusts for all of those kind of scenarios. Okay, cool. There's no more questions. I can move on to the next slide. Yeah, so the next piece is the forward-looking adjustments. So these are estimated through the cycle, meaning like we take like a kind of a long view on the customer, the entire cycle, their book cycle, for Basel purposes. So models usually estimate through the cycle and are subsequently converted into PIT. All this says is historically we look at all your data, but then when we're doing the adjustment, the ECL calc in the end, we use what we learned in the past basically and look at your debtors book at this point in time. Like how does your debtors book look now? How many debtors do you have that are stage 1, 2, and 3, and what are the risk classifications for them? So when it comes to our economic model, we take into account probability weighted change in default rates. What we look at specifically is GDP, repo rates, and CPI. Those should be enough for most products. It's obviously dependent on your product and what economic factors affect what specifically you are selling. So there could be more economic factors you could take into account, or very specific ones. Or an example like CPI is mostly for like your goods sector, but it could be a CPI related specifically to the automotive space, because CPI in a sense it depends on your customer base and what information you have access to and the industry you're in. But this can change depending on the industry you're in. So basically on a very high
I'm going to
level.
pause you there for 1 second. Sorry, can you just explain what is CPR for those that don't know the acronym?
Okay. So yeah, that's your consumer price index. So think about it as like kind of a loaf of bread. It's actually a basket of goods that is decided by Stats SA and the government, and they track this basket of goods over time and see how it increases or decreases in terms of price. So it's a very specific basket of goods. I think it does contain fuel and other costs, and basically they look at how the prices have increased from last year to this year. So it's usually calculated on a quarterly basis. So they'll see how has CPI increased from January to now. How many points has it increased by? GDP, I'll maybe explain that as well. That's your gross domestic product. It's basically the amount of goods produced by your country at a point in time, like how much of goods and services has been generated by the country. So it's like an indicator of a health of a country. So I think like in terms of in the global sense, GDP for the US currently makes up 25% of global GDP. I think for South Africa, it's currently at 1%. Globally, that's speaking in a macro term. Yeah, so but GDP we track basically is as we expect as GDP to increase, we expect employment to increase as a factor because of that, and other positive things for the country. So we expect defaults to decrease, and that's why we take that into account. Repo rates is actually a rate decided by the central bank, and it's basically it's like a loan rate that banks get from the central bank. So let's say the bank has to borrow from the South African central bank. They borrow it at a specific rate. Let's say it's 5%. And then what they would do when they're giving out loans, dependent on your specific risk profile, they will add like a top-up fee for their profits. So they'll add 2%, and then they'll also add, depending on your risk profile, maybe 2 or 3%, just in case you do default. So at the end of the day, when you take out a loan and you receive a specific rate, it's always adjusted for the repo rate. That's basically the bank's borrowing rate. I hope it's not too confusing. If you have any questions, I can clarify it a bit more. That's what's a repo rate. And these are the main three factors we have seen that affect your default rates. They are macroeconomic factors that you can't control, that we take into account. And what we do is when we are adjusting for forward-looking information, we kind of look at what is the best case scenario that can happen in terms of GDP, repo rates, and CPI. And we model those and we say, if the best case happens, we expect defaults to decrease by this much. And then we look at the opposite end of it. What is the best, what is the worst case for GDP? What if GDP goes down? What if repo rates go up? What if CPI increases? So your cost of living increases by much. What will happen to default rates over time? And we put that into a Monte Carlo simulation. But I'll maybe show, I'd like to show you the visual of that. And we basically give you some sort of confidence interval based on the economic factors. Yeah, it is quite a lot to digest. Yeah, but basically what the slide speaks to is that your defaults are basically dependent on macroeconomic factors that we do need to account for, because it's not something, it's an external factor that's not in our control, but we need to take that into account when calculating our CPI. No, sorry, not CPI, our ECL, sorry. And that's what the slide speaks to specifically, is just adjusting your defaults based on forward-looking information. Yeah, this is just a slide just to show you for a specific client. We did this forward-looking adjustment and just take into account GDP, CPI, and what was the other one? And the repo rates. And this is just looking, it's not calibrated yet, just looking at economic factors alone and how well they can track default rates in a specific book. And you can see it gets the overall trend well. So your blue line is your actual default rates, and your predicted default rates just based on economic factors alone. Obviously, we get closer to the line once we take into account your specific book and risk classification, but this is just economic factors on its own, and it seems to be catching the trend quite well. Obviously, there's some troughs and increases in defaults that are very drastic, but it kind of generates a smoothing line based on and that's what happens when you build a model. You usually get a more smooth line that kind of gets the general trend of the defaults, but yeah, it doesn't get it exactly. It doesn't get that troughs at the bottom. So yeah, so this is why we take that into account. We've seen that economic factors actually do play a role in determining what your book default rate would be. Yep, and that kind of brings us to the end of our slides. I do want to show maybe demo the dashboards that we currently have, and maybe it'll help solidify some of these concepts. As I said, it's very high level, this specific one, but yeah. Okay, so I'm just going to open it up. So this is kind of a demo dummy data that we just generated. It doesn't, please, like the values, as I said, doesn't really have any reason behind it. It's just we just generated a bunch of dummy data, pushed them through the model, and saw what happened. So this is a demo account. So what you'd have is your total exposure. Your total exposure is how big is my debtors book, and then we have something called the expected losses. Given that my total exposure is 11 million, I expect 858,000 to be what I need to provision. The unexpected losses is something we need to think of as, remember when I spoke about confidence intervals? It basically tells you in the worst economic scenario, how much can I expect to lose? If GDP goes south, if repo rates increase drastically, if CPI increases drastically, what do I expect my unexpected losses to be? And you as an individual that is the consumer of this information, dependent on your risk tolerance, right? You would think of, okay, you know what? I don't think the economy is going to be that bad. I don't think I'm going to meet somewhere in the middle and make it 900,000 will be my provision. Then we track it over time, because what happens is when it comes to a debtors book, your debtors book changes over time. So we track it on a monthly basis. So we see like over time, you can see for like September, obviously this is dummy data, but we can see that for September, your expected losses are much lower. It could be for that month, your debtors book look much better. I maybe never give credit to people I'm not supposed to be giving credit to, the riskier guys. I'm now giving credit to the less risky individuals. And that's why my provision rate is actually, I can provision much less than I needed to compared to the month of October, November and December. So yeah, so your provisions does change over time. But usually companies, they basically adjust only at the end of the year. So they don't take like they take more of the, well, what can I wait? What can I say? They're not very, what I've noticed in industry as well, they kind of react, they're more reactive to it. So they don't track it every single month. They usually just track it dependent on the year end. So the year end will be December, and that's when they'll calculate it. We do have clients that track it quarterly. So every quarter they'd like an amount so that they don't get shocked at the end when they need to report their provisions that, oh, it's such a big or small amount. They already know what the value is going to be around. So yeah, Neil, I see you have a question.
Yes, thanks, Sayal. Awesome explanation. Just a quick one on the 12 months. So if a company were to do it once a year, like you say, right? Obviously their graph might be a bit different, might be unstable, might not be, might be actually like a perfect line if they're really stable. Do they then take, if they're doing it once a year, do they then take the average of the estimated credit losses and report on that?
Okay. So yeah, so what happens
Or
is, right?
provision,
So
sorry,
this
not the losses.
Okay, so this line speaks to we ran the ECL calc dependent on your book, how your book looked at in January. So you had a certain bunch of debtors, and we ran an ECL calc. So you can see for January, your book, how your book looked at January at that point in time, right? If we had to do an ECL, which is basically how much I should provision at January, it will be 1.28 million. Well, the unexpected. Let's work with actually that's value at risk. Let's work with this 0.98 million, right? So a company basically, right, in their financial statements, they only need to report on the ECL once a year. That's by regulation, right? Dependent on the year end. So they can show the shareholders, this is how my debtors book looks at this point in time. This is how much I provisioned, and they can decide, to buy more shares into the company or, buy less shares dependent on how the net profit looks in that company's book. So why it's nicer to run it monthly, right? So I know the movements of my book over time. So now when I reach the end of the year, I'm not too surprised. I know my value. Let's say I run it monthly. I know my value is going to be the lowest is 0.65. The highest I've seen before my December reporting period was around 1.8 million. So then I can say my provision is going to be between 0.65 to 1.05. Whereas if you only run it at the end, you have no idea what your historic provisions were, like how your book actually moved. So at the end, when I do tell you, well, this is dummy data and it's an example, it's actually 683,000 rand. You're not in shock. You kind of knew how your book was moving over time. So whether you run it once a year or multiple months, it doesn't really matter. We'll still take your entire historic data. So we'll always take your historic data. It's just when we run it at that point in time, how your historic data looks and how your debtors book looks at a point in time. So I'm taking an average. So this isn't an average over time. It's at this point in time, how your debtors book looks. Do you have a lot of risky debtors? Do you have debtors that are within terms? So it's not actually an average. It's just at this point in time, how my debtors book looks.
Awesome.
Yeah.
Thank you, Sayal.
Yeah, so it's all dependent on how many times you run it. So if you had to only run it in December, you wouldn't get lines or trend. You'd get like one point in time. This is your provision at this point. Cool. I don't think I'm gonna go into yeah, but this speaks to when I was talking about we running stuff through a Monte Carlo simulation, adjusting for the worst and best economic scenarios. What we get outputted is this nice normal looking distribution. So we can tell you, so your bottom end speaks to the best economic scenarios, the top speaks to your worst economic scenarios. And as I said, depending on you and your risk thresholds, right? You obviously don't expect the worst economic scenarios to happen. So I usually recommend you work with the 50th percentile, which is your mean. And that's what you adjust for. If you are a bit more skeptical, you believe, okay, I need to provision a bit more. I don't think economic scenarios are going to go well next year. I expect it to actually be at 980,000. You can be a bit more conservative with your provision rate. And obviously 95th is like worst case. I wouldn't recommend you this. You might be a bit too conservative with it and you might be overestimating your provision. Cool. And then the last thing I do want to show is it's called the class breakdown. Just needs to load a bit. Yeah, I'm just gonna wait for it to load. Show why it's slow. So yeah, this is obviously dummy data. So this is just showing demo book. You can see the total exposure is 11 million for this demo book. Within terms, from your 11 million, you have about 6.7 million that are within terms. So they are paying on time. In your 30 days, you have 1.6 million and 60, 90. And you can see your 120-day bucket isn't, which is defined in this scenario as default, has a very small amount. So what the ECL calc basically does is it says dependent on where you are in the matrix and your segment. So your segment, as I said, this demo account has 7 risk classes or classifications. Dependent on where you are, we'd take, using historic data, we'd take your historic movements. So obviously this just has for risk class 2. So if you look at risk class 2 within terms, and we look at this within terms, it's just kind of a multiple. We expect 22% of this within terms in risk class 2 to move into a default state. And that's what we provision for that specific area you are in the matrix. And obviously this isn't a nice looking book because it's based on demo data. They all got categorized in kind of different scenarios, and the historic data is also demo historic data. So this is just to demo how the adjustment's actually done. So depending on whatever risk class you're in, we adjust you, and whatever your point in time, how your book looks at a specific point in time, we give you a provision based on that. So in the ideal scenario, you want all your debtors to be within terms. If they're all within terms, we adjust a lower amount compared to if they're in the 90 or 60-day credit terms. Cool. Sorry, I know it's a lot to digest. I didn't want to also get too technical with it. And I hope kind of most of your questions did get answered. I think that's
Absolutely.
Clear as mud, as clear as mud. I'm sure there's a lot of questions, and guys, if you have questions and you do not want to ask it on this platform, please do not hesitate. Give us a call. We'll set up a session with you, and you can then give us a bit more insight as to who you are, what business you're in, what you do, so that Seville or someone can just give you a bit more guidance as to how we will adjust these various stages and parameters according to your industry or your debtors ledger, and we can assist you in helping you calculate your ECL.
Absolutely. Thank you. Thanks so much, Sahil, and of course for your expertise. And this session was really to show everyone what is ECL, because every business should be doing this. And, it plays a huge part in your budgets as well. So I know you mentioned earlier, Sahil, that some people only do ECL once a year, which could be quite tricky. So if you understand it, or if you, what's the word I'm trying to simplify it, to say that ECL is basically putting aside money to say, I think I'm going to have X amount of money that's not going to come in, that you would have to write off as bad debt. And so we take that into consideration when looking at our operating profits, to make sure that we've covered all of our costs, to make sure that we can pay everybody's salaries. And we have this little kitty, let's call it that. A little kitty could be a lot of money, but a little kitty that just says, this is what I'm putting aside for the rainy day. That's the best way to explain what ECL is in layman's terms, to say I'm putting aside money, and this is how I'm going to decide how much money to put aside based on risk factors, to say you may need this money at a little later down the line because this person's not going to pay you. And therefore, I've put aside a little bit of money that says, if this happens, I myself, my business is not going to close down as a result of that. So that's really why we want ECL, and what we use ECL for is to say, how much money do I take and put in my little kitty to say when something does happen, that I have provisioned to make sure that I've made sure I've kept that money aside. So that's the best way to explain what is expected credit losses and why we do that, and why it's so important, and why it's important to do it on a regular basis and not wait until your financial year end, so that you can budget correctly, so that you can allocate all your funds correctly for your entire business, and therefore making sure that the longevity of your business as well, that you survive the year or the crisis or whatever is going to happen. And that is really what we wanted to show you today. Of course, what we also did show you today, which is a little bit of an insight into a product that we don't currently, we haven't outrightly said that we offer this yet. It is actually a sneak peek into a product that is going to be released in the next, well, it's actually available now. But we haven't yet announced it. So if you are on the call today, you are getting a insight into what is coming next. And this is based on feedback that we've had through multiple client engagements to say this is a part of their business that they really struggle with. So if this is something that, you know, as we said earlier, you want help with, reach out to us at support or at your account manager. If you just want to chat about it with Sahil or with Martin or myself, we can also do that as well. So we just wanted to, you know, it's very important that you understand what is ECL, how does it affect your business, and if you are a credit controller or even in sales, what impact would that make on me if my business doesn't do this correctly? So very important to understand everything that is taking place within this environment that would affect you as an individual. But I don't see any questions yet. So I'm going to pause there for a moment to see if anybody does have a question. Yes, I can see, Sharif, you have a question. Please go ahead.
You're on mute, sorry.
Hello, sorry about that.
No worries.
Sahil, this is for you. I think you need to break this down a little bit lower grade. Your English and everything is too high a grade for us. You're losing us completely, especially with your terms and terminologies.
Okay, no, noted.
Perfect.
That feedback. Thanks.
Thanks, Sharif. So what we will do for you is I'm going to post the video, and then I will sit with Sahil as well, and all the acronyms and lingo that we've used, we'll break it down for you as well, Sharif, to say, you know, what does this mean? Because even for myself, you know, who is in the industry, it is difficult to keep up with what is GDP, what is CPI, what are even some of the, let's call them images in that math sum that we use, and it can get lost in translation. But absolutely, Sharif. So that's what I'm explaining, what it is in terms of what is ECL. In terms of the calculation and how it's done, it is obviously a complex process, but I take your point into consideration, and I will do my best to explain it as well in the breakdown that we'll attach to this recording.
Oh,
Yes,
thank you.
Thank you very much, Sahil, for your. It was actually done very well. It's unfortunate that those terminologies are just the reality, and that's, you can't change the word to make it more understandable. It is just what it is. And once you get to grips with what those words mean and use it on a frequent basis, that's where it becomes helpful. And the nice thing about this product that we have on the market now, okay, you forgot to say, it's under Google. First buyers, 5% discount, 20 buyers, come. But guys, if you run it on a regular basis, you are far more prepared for your half year end and your yearly provisions that you have to make and set aside than what you would do if you do it at the last minute and try and calculate it. This exercise that was demonstrated to you now in an automated process can take you weeks to do if you're going to try and calculate it manually. And even with an Excel document, you've got to import information and set up your parameters, change your parameters in a regular basis. All of this way the calculation is going to come out. But thank you once again. If there's no more questions, I think we can close.
I see there is something in the chat. I just want to see what it says quickly. Oh, sorry, Ashwell said there's a lot of background noise.
Someone's microphone was open.
Okay, perfect. Thank you so much, everyone, and
Thanks, guys.
we appreciate your time as always. And we'll touch base again. We'll see what we can do about minimizing, and see if we can break it down a little bit further for you.
Awesome. Thanks, Amy. Thanks, guys. Thanks, Sahil.
Bye.
Really
Bye-bye.
appreciate it. Cheers.